It's here, 2026, and we're going to give you the 6 stocks to pick in 2026. Now, I'm a certified financial planner, so past performance does not guarantee future results. I'm not just an internet person. I have clients in real life. We manage hundreds of millions of dollars. So this information is for you, and your risk tolerance will tell the difference. But we are going to go over the 6 stocks that we need to get with. Y'all ready? Before we get started, as always, like, subscribe, to share to our channel. In real life, I'm a certified financial planner, as I said before, but on these social media airways, we'll give information. You ready for these 6 stocks? The stocks of 2026. Lego.
And you just wanna get paid. Tired of making the money mistakes. Make a payment on your bills and you still late. Yeah, pay for profits to help you seek change. And you just wanna get paid. Yeah, tired of making the money mistakes. Make a payment on your bills and you still late. Pay for profits to help you seek change. Yeah, cut the show and just listen. You wanna feel empowered by making money decisions.
Now, when we talk about investing, what is the one thing that you always want to do before anything else? Buy low. The reason why we buy low, how low can you go? How low can you go? The reason why is because it's all about pricing. People make the mistake when it comes to investing that they just want to buy the hot stock. It's going up. I'm YOLO. I'm going to miss out. I have FOMO, fear of missing out, and they buy it at its top. Look no further than the Trump coin. Now, we have our opinions about the Trump coin. Was it a Ponzi scheme? Was it a rug pull? We don't know, or do we? But what we do know is that everybody who bought it when it was going up like crazy, they lost because it shot back down. So this philosophy in investing we use, and I recommend you maybe look at it as well. It's called the Cliff Dip Bear. Cliff Dip Bear, what is that? If we have $100, then the first $25, buy that investment, right? Put your toes into the water. But this is where it gets fun and gets interesting for your portfolio. When it goes down by 5%, because historically, most stocks go down by 5% every 6 months. You buy it at a discount. Then when it goes down by 10%, that's the dip. On average, most stocks go down by 10% every 10 months. Average and past performance does not guarantee future results, but on average, 10 months. So now you bought that same stock at a 10% discount. But then it's the bear. And the bear is 15 months. Historically, most stocks go down by 20% every 15 months. So basically once a year. By doing this strategy where we buy in, and when it goes down by 5, buy some more, 10, buy some more, 20, buy some more. This allows us to, historically speaking, outperform the stock market. And with less risk, because we're buying things at a lower price. So that's the first thing we want to do. The second thing we want to do is check your risk tolerance. If you are risk adverse, meaning that if the market goes down, I'm going to feel a little bit skittish. I always feel like the market's watching me. Then you know what? You might not want to invest all that $100. You might want to invest a little bit and tiptoe into the market like I talked about. So your risk tolerance is important. And then number 3, we'll listen to these 6 stocks. Now, again, as a certified financial planner, not a recommendation, it's information, but I'm trying to teach you why these 6 stocks in particular have the potential to not only outperform the market, but might be an investment game changer for your portfolio. Number 1, the first one, Atlassian Corporation, TEAM, symbol TEAM. The reason why? Well, first off, Wall Street likes it because they give it a moderate to strong buy. Does Wall Street get it right all the time? Of course not. But you have more individuals than not saying it is a moderate to strong buy. And we know what happens. Wall Street pushes something because they like it? No, because they have money behind it. So all the stock analysts that said it's a strong buy, they got money in it. So they have a vested interest to see it go up as well. But they have solid growth, year over year growth, which means one year to another, year over year. Why, oh, why? Why, oh, why? But it is 20%, meaning their growth each year is 20%. Think about if you had a job and every single year you had growth or a raise of 20%. Would you be considered a good employee or a bad employee? Of course, a good employee. So 20% year over year revenue growth is pretty good. And also, they are in the industry that is just starting to grow. Cloud. What is cloud? Well, 30 years ago, they had those big servers and those warehouses where they stored information. Not anymore. It's on the cloud. And their model is pretty cool because it's service as is. They call it SaaS, SaaS. So if you're a big company, you're going to use a lot of them, you're going to pay. If you're a small company, you only pay what you use on the cloud. So it gives their consumer base an opportunity to budget correctly and scale when they want to, meaning not a lot of cancellations. And as a business, if I don't have any cancellations, if I have revenue that continues to come consistently, that's a good thing, my friends. Now, it's pros and cons. So we always want to give you the good and the bad. This company, not profitable. When I say unprofitable, I mean on a GAAP basis. And their GAAP basis means operating losses and a negative profit margin. The reason why, because they spend a lot of money on R&D, research and development. They are a growing company. And when they pay their employees by stock compensation, then the net income goes down. And less net income can mean a loss or no profits. And right now, that's going on with teams. But from a stock standpoint, this is why it is one of our picks. You guys see it. Well, my friends, as you can see on the screen, it was as high as $332 a share. And that puppy is down to now $163. Again, it was at $322, now at $163, down by 96%. If it makes half of what it did, if it just gets back to, let's just say, to 19, where it was in July, from here, that is a gain of over 50%. If it gets back to where it was, that is a gain of 100%. Not saying it's going to happen, but to have a company that year over year is making more than the average company, right? 20%. To have a company that is at a low from a stock standpoint, but in an industry that's only trending up with higher demand because of chips, cloud infrastructure, and more small business owners scaling, this is an opportunity that might be worth an investor's while. That's why it is one of our 6 top picks. Number 2, the second one is NuScale Power Corporation, symbol SMR. And you're like, who are they? Well, years ago, many years ago, we were all about what? Nuclear. And then something horrible called Chernobyl happened, and that basically stopped nuclear all over the place. Well, we have an administration, the Trump administration, that loves nuclear. They don't like wind, they don't like solar, but they love nuclear energy. So if you have an administration that's pushing nuclear energy, and you have a power company that literally resurfaces, remodels, and gets power plants back to where they're supposed to be using quote unquote clean nuclear energy, whatever that is, don't you think they're going to get a push from the administration? Or do you think that happened already? It did. And if they're able to create the energy and the production of a nuclear power plant, but having in these small, scalable reactors with low upfront costs and a lot easier to deploy nuclear power, you think that's a good thing or a bad thing? The revenue, they're making money. They're making millions, so they're making money. They also spend a lot of money on R&D as well, as we talked about, research and development. So they're growing. A lot of their profits they're putting back into their business so they can grow and scale. Hence, NuScale Power. But also we have the cons. And the cons is that the company, they're operating at a net loss, meaning that they're losing more money than what they make because they're reinvesting all the money. They're not making anything. Typically, early stage company. Now, with early stage companies, 2 things can happen. They can go up like crazy, or they might go down. And nobody knows but God the future. But they're getting a nice bump in the back for the administration. And we know the administration does not want to lose. So they're going to pump more money. Hence why we think it's going to be a grower. Also, the stock chart. Do we see a common theme here, my friends? Yes, it was at $20 a share and went all the way up to $53 a share. And it has been going down. Now today at $14.32. From 50 to 14, that is a drop. If we had that stock at 50, we're mad right now. But from an investment standpoint, one man's trash, another man's treasure. Being at 14, opportunity to buy something very low. If it gets back to $50 a share, that's a 296% gain. If it gets back to $25 a share, that's almost doubling your money. Now, Is the administration right or wrong? We don't know. Is clean nuclear something that's going to last? We don't know. A company that's growing, we do know, is potential. Do we invest on potential or on stability? Well, that's how investments go. Because the more stable companies, they're stable, might not give you a return, or they might go down a little bit. The ones with the potential usually grow the most. Past performance doesn't guarantee future results, but usually that's what happens. With this, if it just gets back to where it is, that's a 296 return. My friends, potential. Number 3. Well, anyone who has children, especially like children between 8 to 16, like my daughter, you know about Duolingo. D-U-O-L. What is it? It's a company that's taking money from our pockets every day. Because my daughter, she wants to learn Chinese. If you want to learn any language, Duolingo is the place to go. Investment-wise, the young manipulate the market because that's the ones that's spending money. They think money goes on trees, and us parents fund them. So Duolingo has a competitive advantage, used for education, but also is being used by the youth. They have a PE ratio, which stands for price to earnings, over 22%. That's pretty good. And they raised their 2025 year expectations back a few months ago, meaning that they're making more money now than what they thought they would be making for the year this time last year. Growth in the youth is something you can't put a price on. Now, the stock chart, it says something different. And you're going to see a common thing with these 6 stocks. We're buying something at a deep, deep discount that has the potential to grow. As we can see, Duolingo, it was as high as 300, what? As high as $540 a share. Today, it's at $177. That is a drop of all drops, my friends, 70%. So you got to ask yourself, if I had this stock at $540, I would be upset right now. But if I had the ability back 6 months ago when it was at $500 a share, and I told you today it's at $500, but you could buy it at $177, what would you say to yourself? Sign me up. But right now, you might not feel that because it went down like crazy. From an opportunity standpoint, the opportunity cost, the cost of you missing out on the opportunity cannot get any higher than Duolingo. Not a recommendation, just information. But because of the growth, because of beating expectations, because of the youth being on this, and because of the stock being so beat up, this is something that's in our top 6. Number 4, 5 years ago, people would have loved to be in front of the chip industry. So we ask ourselves as investors, what's the next big thing? Well, Wall Street and a lot of people that's Wall Street adjacent, the venture capitalists of the world who move all the money, they think that quantum computing is the way to go. To the point that Jensen, the CEO of NVIDIA, 9 months ago said we're 3 years out from quantum computing, but then hired 25% of his workforce to be quantum computing people. And then on the earnings call last month, said that quantum computing is right before our eyes. That shift in 9 months was diabolical. That's called manipulation. So because the market's being manipulated right now into quantum computing, and because it might be the next thing like chips were 5 years ago, would that not be a pick? And the leading quantum computing company is, for right now, QUBT, or Quantum Computing Inc. And yes, their company, they're growing revenue-wise. They are up by 280% in revenue. I repeat, their revenue was up by 280% year over year. Last year to this year, a 280% difference of revenue. That, my friends, is amazing. And they also announced that they're now doing strategic partnerships with chip companies. Will it be NVIDIA? Will it be AMD? Will it be TSM? We do not know. But them getting involved in chips and chips latching on with them as quantum computing becomes a thing. What is quantum computing? Quantum computing is being able to solve algorithms, to solve math problems at the snap of a finger. Like, what's pi? It takes all year to figure out what pi is. Quantum computing does it in milliseconds. So you think about doctors who are trying to find trial work and trying to find calculations to get the right things in order for medications. With quantum computing, it speeds up the process. This, my friends, is a game changer. Their stock, Well, look at the chart. As high as $25 a share, now it's at $10. If it gets back to where it was, that is a 145% gain. Will it happen? Nobody knows for God the future. But we're in the industry that's evolving. We're in the industry that might be like the chips are right now. And we have chip companies trying to explore a way to use quantum computing in their chips, and we need it to help cure diseases like cancer. QUBT, another one. Number 5. Well, number 5 is The Trade Desk, or symbol TTD. Now, it's not a small company. They have over $18 billion market cap, so they're pretty big. And their PE ratio, their price to earnings ratio, is 44x. 44 times price when it comes to earnings. That's a very strong PE ratio. Common theme, because what they do, cloud. You're going to see cloud is the future, and they are one of the leading companies in the cloud space. But their niche is their software, which enables advertisers and agencies to plan, buy, and optimize by measuring data. So making decisions when it comes to data and ad campaigns across formats like TV, video, audio, and mobile. If we had a chance to run ads targeted with data that will be proven to work, we pay a little bit of money to do that. And TTD allows you to. Identified need, necessity, helping people scale, all at a low cost. That, to me, looks like it might be some growth. And Wall Street think the same. They have it as a moderate buy. Remember we talked about earlier, when Wall Street said it's a buy, it's a reason behind it. They're pumping money. They're trying to pump it up. So we might be able to take advantage of that if you were to buy it. Look at the charts. It's a common theme. TTT, down like crazy. As high as almost $125 a share in February. And that thing went crashing down. Crashing down, now at $38.12 a share. So you're like, why should I buy something that was at 125 in January and now at 38? Should you? Well, it's your opinion, your decision, not mine. We're just giving information, not a recommendation. But if I'm able to be in a cloud-based company, one of the leaders in the space, and I'm able to buy it at a significantly deep discount, would you do it? You see, anybody who had this time last year, as it was growing, thought to themselves, man, if I could have bought this at $38 a share. Right now you can. What's changed? They've made more money. They have a higher PE ratio. What's changed is that Wall Street, for whatever reason, manipulation-wise, thought it was valued at too high. At the same time, they say it's a buy recommendation. So how can it be valued too high, but they're recommending you buying it? Wall Street for you. And the last but not least, Paycom Software, symbol PAYC. Now, they're a technology company. And what do? Cloud-based services. You get the point here. Cloud, the next chips, in my opinion. But the cloud-based, not for everybody. It's for certain types of people, which is HR. And we know any business, HR is vital. When to hire, when to fire, when to bring people on, when to give them raises. So they only do this for HR servicing companies, a niche in the cloud space. Between payroll, talent acquisition, time, labor management, HR analytics from front to end, they are there. And guess what? They're also part of the S&P 500. So anytime you buy an index fund, your money indirectly is going to PAYC. Market cap, $9 billion. So, mid-sized company, and they pay a dividend. That means they're making money, because with a dividend, when we make money, we give it back to you in the form of earnings or a dividend. So that's a good thing. But competition, ADP, Paychex, competition. Also, let's be honest, business owner, are you really thinking about HR where you're just kind of growing? No, you're not. So HR is usually on the back end for small or mid-sized businesses. Large businesses need HR to be compliant. Small businesses, not so much. So with any investment, it's a risk involved in buying that company. Look at the charts. And the chart says, well, it's down. I mean, it was growing, right? So beginning of the year, we had some growth as high as $260 a share. Now it's at $160. Opportunity. Able to buy this thing at a steep old discount. We love discounted stocks, especially the ones in industries with growth potential and the ones that show in the past that have growth potential and momentum. Because with investing, one man's trash is another man's treasure. Does that mean PAYC is going to get back to where it was? If so, That's a gain, my friends, of almost 100%. Will it stay where it is? We don't know. Just like with any stock out there, you don't know. But these 6 picks for 2026, in our opinion, give you the potential to outperform the market because of where they're positioned in their industry, in their sector, but most important, the price. And if we invest by price, then we're able to buy things at a very, very low price compared to the all-time high, because with investing, it's location and buying low. So let me know about your thoughts about the 6 stocks for 2026. You guys have a prosperous, great year. And just because 2025 is gone, maybe your financial goals was not met, it's a new day, a new month, a new year for us to grow. As always, let's make some painful progress together, y'all. Be blessed. Past performance does not guarantee future results. But again, check these stocks out. Peace.